As of the market close on Friday, July 26, 2026 at 4 p.m. Eastern Time, stock trading is finished for the week, and SoFi Technologies, Inc. closed at $16.46 per share. That represented a 1.14% decline on the day, finishing near its session low of $16.33 on heavy volume exceeding 92.9 million shares traded. While the surface price action suggests a routine mid-summer pullback for high-beta financial technology equities, the underlying market mechanism points to something far more specific. Wall Street is aggressively repricing the stock ahead of its second quarter 2026 earnings announcement, setting up a sharp tension between retail market expectations and institutional credit realities. Most retail investors tracking SoFi stocks on their daily watch lists assume this pullback is merely short-term noise created by broader market rotating into mega-cap technology favorites like Nvidia stock or Apple stock. However, a closer look at institutional order flow reveals that major market makers are quietly adjusting their risk parameters around SoFi's personal loan portfolio performance and net interest margin guidance. The dominant market narrative treats SoFi as an agile digital disruptor, placing it in the same consumer-facing category as the Robinhood app, SoFi Active Investing, or interactive brokers trading apps. Investors often expect member acquisition metrics and cross-selling figures to drive the valuation skyward, assuming every new account opened on the SoFi trading platform inherently expands profit margins. The reality, however, is that SoFi operates as a national bank holding company. Its financial engine relies far more heavily on traditional banking mechanics than pure software platform metrics. While retail traders flocking to online investing platforms see SoFi as a high-growth tech play, institutional desks evaluate it on capital adequacy ratios, credit loss provisions, and the spread between its deposit costs and loan yields. When expectation focuses purely on user growth, while reality demands disciplined balance sheet management, pricing gaps emerge, creating significant volatility in daily trading sessions. Looking closely at recent stock price action, SoFi has experienced substantial selling pressure over the past 2 weeks. After testing local resistance above $18.50 earlier in the month, the stock surrendered those gains in a steady downward drift, breaking key technical support levels near $17.20. Trading volume during down sessions has consistently surpassed 90 million shares, indicating active institutional distribution rather than minor retail selling. Short interest has also edged upward as hedge funds position themselves for potential macroeconomic headwinds affecting personal loan default rates. Over the same period, broader market indexes have held relatively steady, buoyed by strength in names like Tesla stock. This divergence signals that SoFi's weakness is stock-specific, driven by investor anxiety over how high interest rates are impacting consumer balance sheets and loan originations. To understand why this momentum shift matters, one must examine the macroeconomic backdrop influencing consumer finance. Federal Reserve policy and interest rate expectations continue to dictate how banks price their liabilities and assets. For individual brokerage users and retail investors engaging in self-investing across platforms like Fidelity Brokerage, Fidelity Wealth Management, or Legacy Investment Help Services, higher interest rates mean attractive yields on cash holdings. SoFi has leveraged high-yield savings accounts to attract billions in member deposits, competing directly with legacy institutions and options like Robinhood Cash Management. However, holding high APY deposit rates requires SoFi to generate strong returns on its lending activities to maintain healthy net interest spreads. As interest rates remain elevated longer than initially forecasted, the cost of funding loans increases, forcing SoFi to balance aggressive market share expansion with strict underwriting standards. Institutional investors closely monitor how SoFi allocates its capital across different business segments. Unlike legacy brokerages such as Fidelity Brokerage, Fidelity Wealth Management, or Legacy Investment Help Services, SoFi must manage the risk profile of unsecured personal loans alongside its digital wealth offerings. During periods of economic tightening, default risks on personal loans rise. When Wall Street senses potential deterioration in credit quality, institutional desks trim positions, regardless of how fast the consumer front end adds new members. This dynamic explains why trading volume spikes on down days. Big funds are protecting capital, while retail traders on investing sites continue buying what they view as a discounted growth stock. Comment below how many shares of SoFi stock you currently hold in your portfolio and whether you are buying this recent dip. To fully grasp SoFi's position today, it helps to review its evolution from a niche lender into a comprehensive financial ecosystem. Originally founded as a student loan refinancing specialist, the company recognized early that long-term enterprise value depended on building a complete financial platform. Obtaining a national bank charter was a decisive strategic shift. That charter enabled SoFi to take direct deposits, lowering its cost of capital compared to non-bank fintech originators who rely entirely on warehouse credit lines. Over time, the company expanded into wealth management, launching SoFi Invest, SoFi Robo-Advisor capabilities, SoFi ETFs, and fractional share trading. This put SoFi in direct competition with Robinhood stock trading, Robinhood fractional shares, and Fidelity mutual funds for younger, mobile-first investors seeking to invest online. The business model now spans three distinct divisions: financial services, tech platform, and lending. The financial services segment includes high-yield checking and savings accounts, debit products, and wealth tools like SoFi Robo-Advisor. The tech platform, driven by Galileo and Technisys, provides back-end infrastructure for other financial institutions and fintech apps, creating a recurring business-to-business revenue stream. The lending segment remains the primary engine for net interest income, generating revenue from student loans, personal loans, and home mortgages. While the market often rewards tech platform revenues with higher valuation multiples, lending still generates the vast majority of current profits. This balance creates the central tension in how the stock is priced. Is SoFi a high-margin tech company or a highly efficient digital bank? Past performance reports highlight this structural transition clearly. Over recent quarters, SoFi achieved consistent GAAP profitability, proving that its unit economics could work under tight monetary conditions. Quarter after quarter, revenue exceeded $1 billion, driven by rapid growth in non-interest income and fee-based financial services. Yet, despite achieving consecutive profitable quarters, the stock price has remained prone to sharp corrections. Investors comparing SoFi to online investment options like Robinhood Investments or Interactive Brokers fees notice that while SoFi's revenue growth is steady, its capital structure requires continuous management to satisfy regulatory capital requirements. This contrast between strong top-line headlines and underlying balance sheet requirements frequently surprises retail traders who expect the stock to trade like a high-flying software name. Looking toward the future, several potential catalysts and risks will determine SoFi's trajectory. The most immediate event is the upcoming quarterly earnings report. Wall Street analysts will intensely focus on net interest margins, credit loss provisions, and management guidance for the remainder of 2026. If SoFi demonstrates that loan defaults remain well controlled, while fee-based revenue from its Galileo tech platform accelerates, the stock could retest upside resistance levels near $20 to $22 per share. Conversely, if credit losses expand or deposit growth slows, forcing the bank to raise deposit APYs to keep pace with online investing competition, profit margins will compress, potentially sending the stock down toward its 52-week support zone around $14.90. Another long-term strategic catalyst lies in expanding its investment offerings. As retail investors demand sophisticated wealth management tools, options like intelligent portfolio offerings, structured accounts, and expanded crypto or options features become essential. To capture market share from established platforms like Fidelity IRAs, Fidelity Mobile App, or Schwab Intelligent Portfolios, SoFi must continue innovating its product suite while maintaining flawless app stability. Furthermore, potential interest rate cuts by central banks could reignite student loan refinancing and home mortgage activity, providing a powerful tailwind for lending origination volumes. In summary, the narrative surrounding SoFi remains a classic study in expectation versus reality. Popular expectation views the stock through the lens of a consumer tech app, focusing on member numbers and comparing it to platforms like Robinhood Crypto, SoFi Active Investing, or Interactive Brokers stock trading. The reality is that SoFi is a chartered financial institution whose valuation depends on balance sheet health, risk management, and regulatory compliance. With the stock ending the week at $16.46, investors face a pivotal moment ahead of earnings. Understanding this gap between retail hype and institutional banking metrics provides the clarity required to evaluate SoFi's true long-term value in an evolving market environment.